I reviewed 60 of my own blown accounts, looking for what actually killed them. And it wasn't one specific thing, it was 5 mistakes repeated over and over again. And chances are you're probably going through the exact same mistakes right now. So in this video, I'm going to go over those 5 mistakes and what I did to fix them. The first mistake I made, or the first point, is actually win rate. Win rate is a fucking lie, guys. Win rate is a lie. A high win rate doesn't necessarily mean a profitable strategy, and my mistakes actually proved it. A 70% win rate in theory means that 70 out of 100 trades, you're going to win them. 7 out of 10 trades, you're going to win them. And let's imagine that's actually true. But what it doesn't do is tell you 2 things. First, it doesn't tell you the size of the winners versus the size of the losses. Second thing it doesn't tell you is the distribution of winners to losses. And that simply means it doesn't tell you whether out of those 7 trades, are you going to win the first 2 and lose the next 3? Are you going to win the next 3 trades in a row? And that's not even actually the point, guys. There isn't actually a way to measure a 70% win rate or an 80% win rate. It's just theoretical, because at the end of the day, what actually makes you profitable is not win rate, is risk to reward. You can decide to journal all the trades you took in the first quarter of the year, and you probably maybe won 60 of those trades. But you could again journal all the trades you take in the second quarter of the year. It's possible you only won 10 of those trades, and that has nothing to do with your win rate. Maybe that has to do with some of the fact that the forex market is kind of subjected to some level of seasonal variation and not necessarily your win rate. To me, I had a very profitable strategy. On paper, my mentor would say, oh, we have a 70% win rate, we had an 80% win rate, but that isn't actually true. But the truth I want to tell you is win rate isn't fixed, it's dynamic. It changes based off your mood, whatever actions you take, and based on a series of market conditions, based on how many bills you have to pay sometimes in a month. Because theoretically, especially for people that have a small trading account, and the more bills you have, you basically think the more trades you need to take. Don't you think that taking more trades outside of your plan will affect your win rate? But the most important thing for me that made me lose money wasn't even the win rate, but it was because I wasn't defining a certain dollar amount, a certain dollar risk on trade. So because I thought, oh, out of 10 trades, I'm going to win 7 and I'm going to lose 3, I wasn't bothering about my risk. I would just enter a trade, slam a take profit, and then I lost the account more often times than not. So the fix for that is, irrespective of the fact that you think you have a high win rate, you need to define a dollar amount for your trade, because you can win 7 trades in a row, and without defining risk, without accepting a small loss, you would take the mother of all losses and within 3 trades blow your whole account. Now, the second mistake I made was not having an exit plan for when I was wrong. Every single trade I took, I would set a target, an exit point for when I was right, but I never set an exit point for when I was wrong. There was no stop loss. No stop loss was defined at all. So when a trade went against me, I had a plan in place to tell me to get the hell out of the trade. There was no plan. And when you don't have a plan for exiting a losing trade, you're just going to sit there looking at your account bleed. I kept holding these trades, hoping that the trade was going to come back to my entry. But guys, until now, that trade hasn't returned to my entry, and my trading account is gone. The only fix for this problem is defining an exit point, not just in terms of when the trade is going in your direction, but when the trade is going against you. So in your plan, what are some invalidation criteria? If you're starting to see breaks of structure bearish, or whatever structure your strategy tells you to look for, that's when you should exit a trade. If not, you're going to just be like me and keep blowing accounts. Speaking of holding trades until it comes back to your entry, there's a psychological trick that most supermarkets play on all of us without you even realizing it. We've all seen this buy one, get 2 items on discount. right? Or we've all seen this where an item was 9900 before and then it's 6000. Think about that when price goes against you. A popular trading strategy is when the market dips, you buy the dip because it now feels cheaper and you're getting a better deal, right? So if Bitcoin goes from $60,000 to $20,000, everybody buy the dip. But that's not entirely true because no one's asking the obvious questions. Do you not think if price has gone from 60,000 to 50 to 40, what do you think will actually stop price from going to 10,000? And that's actually the supermarket mentality that I applied to trading. Now I feel, and that's the reason why I stopped trading crypto, everyone holding crypto is in some way, shape or form guilty of the supermarket mentality. Because I tell you, there were times I was in Bitcoin or gold, and because I felt there's this thing about those instruments that they're naturally designed to keep going up, I didn't see the downside potential. Whenever I entered into a trade, the only thing I focused on was the upside potential, and that created some form of psychological block for me. I was heavily biased on a trade, and if it wasn't going bullish, I never saw the selling potential. And if you think a trading plan will protect you, well, that's exactly what led me to blowing a lot of my accounts. It's not about taking a trade that was according to your plan, because a trade that fits your plan could end up being a loss. Because the plan actually tells you when to enter a trade, but if how much you're going to lose is not in your plan, then you have simply planned to fail by failing to plan. The bone of contention is without risk management underneath, a trading plan is somewhat just useless. And then even the most disciplined trading plan in the world would actually still wipe you out. I want to ask you guys this question. How many times have you taken a trade in your plan and you lost? How many times have you held on to a trade and refused to exit because you think, oh, I have a change of character, CRT has retraced, Elliott wave is forming wave 5, wave 4 cannot retrace beyond wave 1, and for all those reasons, because you think it fits a certain criteria, you hold on to a loss that you were supposed to have cut short simply because the trade was according to your plan. And how many trades that weren't in your plan have you taken that ended up in a winner? But the bone of contention here is, at the end of the day, risk management is what keeps you in the game long enough to see those profitable days. Now, one of the biggest things that actually made me blow some of my accounts, so if I blow like 100 accounts, there was one thing that made me blow about 70 of those accounts, and that's actually the need to be right. And this is a problem that I call the pressure cycle, and a lot of you are guilty of that. So this is how the pressure cycle actually starts. For you to feel the need to be right all the time, it starts with you having a small account. And on top of having a small account, trading is your only source of income. And now you're trying to get the market to do what's structurally impossible, and that is giving consistent high returns at safe risk levels. It's not possible. When trading is your only source of income and you think about the amount of bills you have to pay at the end of the weekend and at the end of the month, you're forced psychologically to hold on to losses and cut winners short. You're not giving the market an opportunity to fill your pockets because you're being scared of taking a loss and always wanting to be right. So here's the thing. There's a general misconception that the more accounts you blow, the more you're actually learning from the market. But here's the thing. The brain is an organ that recognizes patterns. The more accounts you blow, you're simply creating a recognizable pattern for your brain. It doesn't mean you're learning anything, but it simply means you're enforcing a new behavior. Blowing an account is not a sign that you're learning. It is a sign that you're simply an idiot, and only an idiot will continue to do the same thing and expect a different result. So next time you blow your trading account, I need you to do one thing. Just write down the reason why you blow that account. And if you keep writing them, you keep discovering those trading demons holding you back. And the next thing you have to do is find a way, my friend, to slay those demons. Now, if you want to learn how to turn your knowledge into income and escape the pressure cycle and learn how to build other businesses around trading, I need you to check this video out.